Good morning. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And we're talking today about how to pay off all of your debt in an average of 7 to 9 years. But specifically today, how to obtain a virtual 0% interest mortgage. And we're going to be using an article that I wrote a while ago, and it's pinned to the top of the room right now. So take a few seconds out and grab that right now. Go ahead and see, this is something that you can even see while you're in Clubhouse. So go ahead and go to that link right now. Okay, there we go. All right, ladies and gentlemen. So go ahead and share the room. We've got 3 shares. We already have 19 people in here, and it is because of your shares that actually get the information out into the hallways so people can actually see and hear what we're talking about. If you want to see some of the what we're going to be putting on the screen a little bit later on you know, if you want to see it on like YouTube or something like that, so go to ice10kvideos.com, ice10kvideos.com on your separate device, and you can actually watch it there as well. We are excited. Now, if you want to ask some questions, if you want to know more about this, if you want to put your 2 cents in, if you want to have some input, please, this is a safe space. Whether you agree or not agree, come on up and let's have a conversation. Let's talk about it, as they say. All right. Good morning. Good morning. It's all right. It says, good morning. Is this live from where, please? Well, we're live from Huntsville, Alabama. That's where we're located. This is Brian asking this on YouTube. And Brian, I'm in Huntsville, Alabama. And we are also on Clubhouse, a social media app. All right. So, and if you want to know more about all of this information, as it relates to real estate and lending and mortgages, I read something very, very interesting not too long ago about where all of this began. Started in 1934 as part of the New Deal, amortizing loans. Amortizing loans. And do you know that amortizing loans was one of the major factors between 1934 and 1962 to build the middle class? Because now people were able to buy homes. But I want you to also know what was also created between 1934 and now. Okay. Virtually no information was being taught to the people who were using these loans that started in 1934. Do you realize the FHA was created in 1934? Also, PMI, private mortgage insurance, was invented in 1934. So this is when we're starting to be able to buy a home on a 30-year fixed note, and then you can start to build wealth as a regular family who worked a job. Okay, this is a way for people to build wealth for people who worked a job. Now, listen to this, folks. Not only were you able to get a loan, but you got it for 30 years. And I want you to know something here, that although the middle class was built, and part of the middle class and part of that underlying structure was having to be able to purchase a home and not just rent it. The amortization schedule meant that you're going to pay 75%. I will repeat that, and I need you to put that in the chat. 75% more than you were. Somebody put 75% in the chat. If you're listening to me right now, put 75% in the chat. 75 and the percent sign. 75 and the percent sign. Go ahead and put that in there. You're paying 75% more interest than you need to. What? Yes. Because we're paying 75% more interest than we need to, because no one has spent the time teaching us how loans actually work. I gotta get my mic in a different position here, folks. All right, there we go. Look closer to my face. So we're going to learn more about that. There we go. There it is. There it is. I see the 75% in the chat right now. Go ahead and continue to get people in here. So I'm going to go ahead and I'm going to put this on the screen as well, so that we can see what's going on here with this. We'll say, there we go. Copy this, put it on the screen, paste and go. There we are. And there it is, folks. There it is. P.I.L.L Method International introduces the 0% interest mortgage. And we're going to, as you can read the article. I'm not going to read the article to you. All right. What I'm going to do is go down to the example that we have here. Why isn't it not showing up? All right. Come on. Client example. Come on. Show up client example. All right. Why is it not showing up? Oh, because it's not fully loaded yet. That's why. All right. Come on, load. We got to get this thing to load. So while it's loading up, folks, go ahead and come to the stage, raise your hand, come to the stage, and so that you can participate with me and asking questions. So I don't know. Let me see if I can get this to load a little faster. There we go. Come on. Finish up. All right. So there it is. Okay. Now let's scroll down to this. Let me see if we can get that. All right. I'm going to see if I can put this in here a little more. So we're dealing with a $500,000 loan, loan, and the interest rate is 3%. The interest rate is 3% on a $500,000 loan. And I'm going to go over what we have here, and then we can actually get into the inner workings of the loan. So here's what we've got. All right. Let's just say we have a $500,000 loan at 3%. And in the first 60 months, the first 5 years, if you just make the minimum payment, all right, at 3%, here's what's going to happen. You're going to pay this loan down by, let me see if I can get this just a little bit bigger. Hold on. Okay. Plus. There we go. Just a little bit bigger. All right. We're going to pay this loan down by $49,921.48. That's how much you're going to pay the loan down by in 5 years. But guess what it's going to cost? $63,911.72 just in interest to do that. Folks, how is it beneficial to have a 3% mortgage rate and you pay $63,911.72 in interest just to pay the loan down by $49,921.48? Do you see? Amortization makes it possible for banks to charge an exorbitant amount of interest and make us feel okay about it, because we're not paying attention to how much interest we're actually consuming per month. We have a payment we can afford. You see, I just, I forgot what I was listening to. A car that cost $300,000. I forget what it was. It was on the news. But I was thinking about the fact that you can get a 30-year mortgage on a $300,000 house, but you can't get a 30-year loan on a $300,000 car. That has to be paid off in 7 or 8 years. So if we can pay off a $300,000 car in 7 or 8 years, and obviously we're going to pay a lot less interest, then why can't we pay off a $300,000 house in 7 or 8 years? So has anybody ever wondered that? If you've ever wondered that, all right, if that's interesting to you, go ahead and put number 1 in the chat. Put a number 1 in the chat. If you're saying to yourself, what is going on here? You can pay off a car. You can pay off a car in 7 or 8 years that costs $300,000, but you can't pay off a house in 7 or 8 years that costs $300,000. What in the world is going on here? So this is how amortization schedules work, folks. And I want you to know before you leave here, before somebody comes in, hears this and doesn't get all the information, what you're going to find out is you do not have to pay all of this interest. You can cut your interest cost on these loans without changing your budget and without sacrificing lifestyle. You don't need more money to get out of debt. You just need to know what to do with your money so that you can pay a lot less interest. That's the first part. Let's get into this thing just a little bit deeper. Thank you for all of your participation. And if you want to see this online, go right ahead and go to ice10kvideos.com, ice10kvideos.com, and you can see what is going on here. So, folks, here's what we got. In 60 months, in 5 years, pay this loan down by less than $50,000, but it's going to cost $63,911.72. When we add it all together, that's a total paid out of $113,833.20 in 5 years. $113,000, and out of that money, all you would get is $49,921.48 in potential equity. That means the bank would receive $63,000, almost $64,000 to do you the favor of allowing you to purchase a home at a payment you can afford. I'm asking, can we really afford that? Can we really afford to pay $63,000 just to pay the house down by $49,000 and just keep on going? And that's just in the first 5 years. Do you realize right now, today, we are spending our children's inheritance on interest? The average family is going to spend somewhere between $300,000 and $500,000 on interest. What? So if I'm a banker in 1934, and here comes the New Deal. Here comes the New Deal, because we're coming out of the Depression. All right, 1929 stock market crash. Okay, then FDR is elected president. Okay, and then comes up with a New Deal. And now people who were formerly renters can now become home buyers. What? Flame, I'm so glad you're here, man, because listen, man, we're going over some history here. All right? Flame, how you doing this morning, sir? I think, Flame, are you there? All right, Flame, as soon as you can, man, jump in here. All right. So what we're talking about, folks, is this. Listen, in 1934, when all of this happened, think about this. In 1934, when all this happened, coming out of the Depression, did you realize the bankers did not feel the Depression? They had money. They were still living large. There were people in the midst of the Depression that was still had plenty of money and still living like there was no tomorrow. What? Yes. Now, here comes an opportunity. Here comes an opportunity to take a 3% loan and turn it into a 51% return. A 3% loan and turn it into a 51% return. Do you see that the bank wants, I'm going to scroll down here so that you can see. On a $500,000 loan, the bank wants $245,866 in interest. Okay? $500,000 loan, the bank wants $245,866 in interest on that loan. Wow. 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 Then how is that 6% of 500,000? It isn't. It's 51.777%. 51.778% of 500,000. That's how banks do what they do, folks. All right. So I'm not anti-bank. What I am is pro-education. We have some people here on the stage right now, okay, that can talk to you about how to get the money, how to level up your credit, how to obtain credit, how to obtain business credit. And just now, this information is becoming commonplace in the marketplace. But guess what isn't commonplace in the marketplace? How to optimize the use of credit so you pay the least amount of interest that's mathematically possible. You know, that is what's going on here. Listen, let's go ahead and finish this up. And I want to go to the next portion here. All right. Look at this. Look at this. Okay. I want you to see this. Which would you prefer? Which would you prefer? To pay $245,886 interest on a $500,000 loan, pay it off in 30 years, or this. Pay $66,756 in interest to pay off your $500,000 loan and do it in 8.3 years. Savings yourself $179,110. What? $179,000 in interest saved to acquire the same asset. If you could save $179,000 without changing your budget, without sacrificing lifestyle, what could you do with the money that you're no longer paying in interest and the monies you're no longer paying towards that mortgage for 30 years? What could you do with that money? I want you to look down here below, your potential wealth accumulation. And folks, this number that I'm quoting you is if you take that money that you're no longer giving to the banks and invest it somewhere where you're only getting a 1% return on your money for the next 22 years, only getting a 1% return on your money for 22 years, you can grow that money to $1,665,545. Wow. What am I saying here? The average family on all of their debt is going to pay somewhere between $300,000 and $500,000 right now. That's what's going on. Between $300,000 and $500,000 in a lifetime of interest, the way it is happening right now. So if they can cut that interest out and take that money and invest it where it could grow to $1.6 million, do you realize that you can actually earn more interest than you will ever pay in your life? Let me break this down another way, Flame, another way, Credit Goddess, and we're going to come back to you and do some introductions. What if I bought a bushel of apples for $10 and I sold those apples for $20. And I need you to put this in the chat. If I bought them for 10 and I sold them for 20, did those apples cost me any money? Yes or no? Put it in the chat. Did those apples cost me any money? Put it in the chat. Oh my goodness. If you want to, if you're new to the room, go ahead and go to ice10kvideos.com if you want to see this on the screen, ice10kvideos.com. You can also click on the link above and get up. You can save this link so you can permanently have this article that you can refer to. I kind of outlined the whole article here. Okay. So if I went ahead and bought a bushel of apples for $10 and sold them for 20, did the apples actually cost me any money? Yes or no? Credit Goddess says no. All right. Donna Carter says no. Anybody else? What is your yes or no? Did the apples cost me anything if I bought them for 10 and I sold them for 20? Oh my goodness. We're going to get into this thing. We're going to get into this thing hot and heavy today. Folks, let me tell you something. If the average family, Tiffany says no. Here's what we're talking about. If the average family, if they didn't know this information, they're going to pay to own a home, to buy education, to do everything that they were going to do. And we're talking about families that have great credit scores here, folks. We're talking about people who have great credit scores. We have people who make good income, are going to pay somewhere between $300,000 and $500,000 in interest over their lifetime. That's the family. That's per family. And I'm gonna point out to you why that is significant in a minute. Think about how many families there are. All right. And now they're going to pay between $300,000 and $500,000. What if now they can see that instead of paying all of that money, they can actually turn that into $1.6 million in gain? You can actually earn more in interest than you've ever paid out in interest. So the question is, if you get more back in interest than you've ever paid in interest, have you actually paid interest? Have you actually, isn't that the same as getting your loans at 0%? Huh? That you actually paid no interest because you got more back than you ever. Oh, Credit Goddess says, yep. Okay. Come on, folks. Listen, how exciting is that? Credit Goddess, how are you this morning?
I'm great, Don. How are you?
I'm doing fine. Would you go ahead and introduce yourself to the folks?
Absolutely. Hey, everyone. Happy Sunday. It's the 31st. Tomorrow is the 1st of August. I'm excited today. Well, I'm actually working today. Moving and switching up my software, upgrading so that way my clients can get the best experience, more education, of course, streamline, all that good stuff. I have to think about the clients. But anyway, my name is Rosalore Lewis, also known as Credit Goddess. I'm all things credit and the official credit expert for the P.I.L.L Method crew here. I know we're in the mansion, the mortgage syndicate mansion today. But yes, if you guys don't know about the club, definitely go and follow the P.I.L.L Method. You can tap on Don, scroll down to the bottom and find his club there. Join it. He does this every Wednesday, Friday, and Sunday, you guys. So that way you can get this information embedded. But myself, I'm a credit expert. I'm a credit score improvement strategist. And I say improve because I help you improve your credit, not just repair it, but help you improve it. So it's a partnership when you work with me in getting your credit where it needs to be. Also a business credit consultant and an educator at Be Free University. So I'm always here to support Don because I believe in this method. If you guys don't, I need you guys to come in every now and then to kind of get this, this truth here, because this is how we save on interest costs. This is the numbers game, you guys, and just understanding what it is. You'll be able to apply this to your everyday bill, whether it's credit cards, student loans, your mortgage, how to pay off in a shorter period of time than what the banks are giving you, because they're making money when you extend these debts out for the term that they give you. You can pay it off sooner. And for those Dave Ramsey folks, this is how you do it. You can get the loan right now and pay it later. You don't have to save up the funds to get it later. Get it now and then pay it off later by applying the P.I.L.L method. So I'm here to support Don as usual. Thank you, Don.
Thank you, Credit Goddess. And we have RB on the stage. RB, the realtor from New York City. RB, how are you this morning?
Good morning. I'm blessed and highly favored. How are you doing today, Don?
I'm doing excellent. Thank you very much. Would you introduce yourself to the folks, please?
Sure. So my name is RB, the realtor, licensed realtor in the state of New York, also serving Connecticut, a buy and hold investor on the residential multifamily side, which is 4 units and less, and also a landlord operating in the long-term and short-term rental space. But as you guys may have heard, my passion lies in helping people to understand how to create generational wealth through the acquisition of real estate. To that end, actually, Rose and I have a free first-time home buyer seminar, a virtual one, coming up at the end of August. You can click the link in my bio or my rb10k.com card for that one. And for those of you who are local to New York, I have an in-person first-time home buyer seminar that is in collaboration with Chase Bank. And we'll be doing that in person, and it's free as well. On August 11th. We just actually had an amazing event for real estate entrepreneurs, and actually just entrepreneurs in general, that we had in the city of Manhattan last Thursday, which was super successful. I do believe in the power of collaborations. I had teamed up with the New York City Mayor's Office, as well as the the New York Real Estate Board of Realtors, the Harlem chapter, as well as JP Morgan Chase Bank. And we were able to have people come together, connect, build relationships so that we can empower people within our community to be owners and stakeholders, right? So with that being said, I will add value where I can. Definitely encourage you all to get out in person, come to these in-person events, come to these virtual events, figure out how to pay down your interest, because that'll save you money so you can get to the next investment. And if I can be of service for any of your real estate buying or selling needs, whether you're in New York or outside of New York, definitely feel free to reach out to me, as I would love to be of service to you with both me and my team members. Thank you so much.
All right, all right, all right. So, folks, here's what we're talking about right now. The Credit Goddess, RB the Realtor, and RB, you're doing a first-time home buyers seminar. Credit Goddess, you're part of that. Why? And it's going to actually help us to understand why this information that I'm teaching right now is so important. Why do you think it is important to teach what you're teaching? But I want you to hold on to that idea for just a minute, because I want you to come back and talk about it. But I want to get Flame in here. Flame, are you here right now? Flame, are you available? All right. Somebody text Flame. I need him in here. All right. So while we're getting Flame up and ready to talk, listen, folks. Listen to RB. Listen to Credit Goddess while they're talking to you about why it is important to have these first-time home buyer seminars. Why? People buy homes all the time. So, RB, jump in there. Why is that important?
Surely. So the reason why it's important is because a lot of people don't understand that there's a lot of possibilities available to them with funding, with down payment assistance, different programs that the U.S. government has actually put in place because they want to encourage people to own. Being a homeowner not only allows you to be the master of your own domain, right? It also allows you to create something a legacy of sorts in real estate that you were able to then transition and pass down to other people in your family once you're not here. This is the thing. You all need a place to live, and we have been living wherever it is, whether it's with family, whether it's on our own, whether it's renting. But you truly have power and say so and become stakeholders within your community when you have ownership. That's who politicians are gearing their policies towards, people that own within the neighborhoods, and especially people of color have definitely been underrepresented in this area. So there are a lot of quiet, quiet. So there are a lot of people that that are in need of quality information on how to get started. So that's what we're looking to do. We're looking to empower people within our community to understand how to get started in real estate, how to, even if they want to do it as an investor, start from owner occupied so you can get the cheapest mortgage possible, and use that to leverage it so that you're able to move forward and scale and grow in real estate. If you don't own, you truly, truly don't have a voice in your community. And on top of that, you're helping somebody else pay down their expenses and float their lifestyle. You don't want to do that. You want to be able to create a situation where you can tap in to what I like to call the house piggy bank, should you need to. One, in the case of pandemic, a lot of people were able to refinance to take out funds and access that for living expenses. But then a lot of people that didn't need it for that purpose were able to take their property that they have and leverage the investment that they have put into it by paying into their mortgage. And they were able to take that and get other properties. Now we're entering into a period where we're going to see a lot more opportunities in real estate. So while even though the interest rates are a tad bit higher, definitely not as high as they were in 2008 and 2009, but they're a tad bit higher, this is the perfect time to buy, because a lot of people might hesitate, but they're hesitating, which means that the sellers are not going to have as much people trying to get these properties. So now is your time to get deals accepted that definitely couldn't have been accepted within the last 6 months to the year, just because there was so much competition. So you definitely want to own the place that you live in so that you have something that you can claim that belongs to you. And when you need to, when you want to, if you decide to, you can tap into that equity and utilize it for whatever you want. And if you decide not to, now you have an asset that can be passed down from generations to come.
Excellent, excellent. Credit goddess, what's your piece to all of this? What do you say?
Well, you know what? Let me help the visuals to those that are visual, and I'm going to talk about numbers. So a lot of times people count themselves out of purchasing a home because they feel as though, one, and we hear this all the time, one, the prices of the homes are too high. Two, the interest rates are too high. You had an opportunity to come in when the interest rates were low, but now that the interest rates are high, you're counting yourself out. And three, a lot of times people count themselves out because they don't have the funds. So it's so important that you tap into, myself and RB's first time home buyers, because we will actually explain the things that you can have in place. Okay, so if you don't have good credit, I'm here. If you're looking for down payment assistance, RB and her team can assist you with that. So those are the two things that we hear in the community, that they count themselves out. All right. Now, the other part where people say, well, I don't know if I can afford a home, you know, well, if we look at the numbers, and if we look at how you guys are going about saving up for, to buying the home, I'm going to talk about the particular person where, cash, don't use credit, buy everything cash. Okay. So if we're looking at the side of the fence, which side of the fence are you going to be on? Are you going to save up the funds and buy the house cash? Or are you going to get it right now and then work it backwards and get it right now and pay it off? Whatever concept it is, you're either going to spend the time or you're going to spend the money, meaning you're going to spend the time to save up the money, or you're going to spend the money to get the money, right? And save the time to having to save up the money. I want you guys to understand the type of person that you are. If you're not afraid of borrowing, because you have your ducks lined up in a row, you have your savings account, you have your emergency funds, and you also have the P.I.L.L method. The P.I.L.L method is going to actually teach you how to save on interest costs. A lot of times we're not thinking about the interest costs that we're paying. We're focusing so much on, can I afford the monthly bill, right? But if you can afford a little bit more, for those of you guys that have a little bit extra, or if you have that spouse, that extra income, you guys can work out this plan and pay off this mortgage in a shorter period of time. The banks give you 30 years to pay off the mortgage, but do you have to wait 30 years? No. And let's talk about the folks that are counting themselves out because of the higher interest rate. I'm not sure if Don went through this, but a higher interest rate is a lot cheaper than a lower interest rate. You probably like, what? Credit guys, what you talking about? Ask Don, and he will show you having a higher interest rate mortgage, you can pay off the home in a shorter period of time and cheaper than if you had a lower interest rate. He'll show you that example. So I don't want you guys to count yourself out because of the amount that you hear. You ever like you're hungry, and when you or you're not hungry, let's say you're not hungry, and you look at this plate of food and you're like, oh my gosh, you're already counting yourself out like, oh, I don't think I can eat all that. When we look at numbers, we automatically say in our mind as a consumer, oh my gosh, that's too much. But if we know how to put things in place and put the plan together and stick to the plan for the common goal, which is one, obtain the home, obtain the deed, because once you have the deed in hand or the title in hand, that's your house. But if you're still paying on it, it's you and the bank's house until you pay off that mortgage and you have that title in hand, that deed in hand. That's your house. So how soon do you want to own that house and put that plan together in a shorter period of time? And then rinse and repeat. With this P.I.L.L method, you guys can buy 2, 3, 4 plus homes in your lifetime. You don't have to wait 30 years. So with all that said, ask Don, come up on stage, ask Don, what was Credit Goddess talking about, and show me. Because yes, you can own a home, 2, 3 homes in a lifetime with this P.I.L.L method. So I'm gonna land it right.
Thank you, Credit Goddess. Listen, folks. Some of you weren't in here from the beginning, but now I'm have to recap some of this so that we can understand what these ladies were talking about. Flame, are you in the building yet? Flame, are you there? Flash your mic if you are. All right. So can somebody text Flame or give him a call? Because I want
text him already.
Great. I'd like to get him into this conversation. All right. So, folks, here's what's going on. I'm going to put something else on the screen, and then we're going to dig back down into this thing. All right. So I need you to see what's on the screen right now. It's called opportunity cost. Opportunity cost. Okay. And let me see if I can make this just a little bit bigger so everybody can see it. All right. Opportunity cost. Here's what it means. This is opportunity cost lost. To determine the cost of a lost opportunity. All right. So when you do something, you take advantage of an opportunity, right? But then when you take advantage of that opportunity, you can't also take advantage of another opportunity because you're into this one. All right. So follow this. To determine the cost of a lost opportunity, subtract the value of the choice you made from the most valuable choice. Oh my goodness. I need you guys to focus in on the most valuable choice. If you buy your home at $500,000 at 3% and do it the traditional way, all right, and you figure out, here's how much interest I could save, and you enter into a plan to save yourself some interest and some time, then you have some choices to make. Do I pay all of the interest or do I save some of the interest? But to truly figure out opportunity cost, you need to know the most valuable choice. Folks, the way amortization schedules are created, it is impossible for the average person to figure out the most valuable choice. You can figure out a more valuable choice, but not the most valuable choice, because there are too many variables to consider. There's just too many things going on, and you can't do that. You can't figure out the most valuable choice because it would take you hundreds and hundreds of years to do all of the calculations involved in figuring out the most valuable choice for you. So what the financial institutions have come up with, what the financial gurus have come up with, are rules of thumb. that you can save some interest, like a biweekly payment will cut your interest costs some, and then you will able to pay your loan off in about 7 years 7 years sooner, which means you can turn a 30-year loan into a 23-year loan. Okay. Or you can figure out how much money you want to put extra on your loan. But the problem with that is we are never told how much interest we're actually saving. Well, let me ask you, has anybody ever put extra money on debt? Have you put extra money on your credit card or car loan or your mortgage? Put a little bit extra on principal? Has the bank ever sent you back a receipt? And I need this answer in the chat. Has the bank ever sent you back a receipt stating, here's how much interest and time you saved by giving us that extra $100? Anybody? Has anybody ever received a receipt from the bank stating, here's how much interest you saved with this extra $100? Anybody? Extra $50, extra $20, whatever you put extra. Did you realize how much interest you saved? I get a bunch of no's. I'm getting a bunch of no's right now. And the reason why I'm getting a bunch of no's is because interest cost, we are left out of the loop to understanding interest cost. If you can't optimize what you cannot measure, if you have no idea how much interest you're spending per month, if you have no idea how much interest you're saving anytime you do an interest saving measure, then how can you do the calculations to figure out how to save the most amount of interest? Oh my goodness. I promised you that I was going to debut our brand new TV commercial with E.T., the hip hop preacher, stating he paid off his mortgage in 4 years using the P.I.L.L method program. And we took that because he was live at our event in May. We took that information and developed a television commercial out of it. We're also promoting what he said on social media. So you'll see it on YouTube. You'll see him on Facebook and Instagram. But I want to play for you, for the first time publicly, the new commercial that is going to start tomorrow. All right. If you want to see it, go to ice10kvideos.com, ice10kvideos.com on your tablet or your computer, and you'll be able to see it. But we're going to play it now, but we'll play it again if you're not in a position. In the meantime, folks, start sharing the room. Let's go ahead and play that new commercial. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L method. I invite you to watch and listen.
Listen to me, y'all. Well, one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today. All right, folks, you heard it. Go to pillmethod.com and find, when you go there, you'll find a link that says get a savings and earnings report. You can know the month, day, and year you could be debt free. All right. Listen, go ahead and keep sharing the room, folks. Keep sharing the room. We had a question in the chat. I'm asking Sir. I forgot how to, sir. I don't know. Oh, here he comes. Come on up, sir, and ask your question. And let's see, invite him up to speak. There he is. All right. Come on up, sir. And we'd love to talk to you about your question. Go ahead, sir. Ask us your question.
Hi, Ice. Yeah, thanks for having me up here. I just wanted to know the P.I.L.L method, what it means. Is it like an acronym or something? And how does that work? Because I keep hearing it, but is it something, that I have to wait, in the room to find out?
Oh, no, you can find out right now. P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. We take these basic concepts and use this information in our opportunity cost calculator, which is a cloud-based, artificially intelligent computing platform that does all of the math and guides you and gives you information just like GPS, like a financial GPS, telling you how much money to move, what month to move it in, what day of the month to move it on, and we're going to calculate for you your interest savings so that you can pay off your debt, not with extra money, but with your current budget optimized to save you the maximum amount of interest per dollar applied. And our average client pays off in 7 to 9 years. But just to give you a quick overview, P.I.L.L, the P stands for prepayment of principal. You know that you can prepay principal at any time. You can put extra on your loans all by yourself. You don't need us for that. Okay. But isolating the principal amount means how much money do we pay and when do we pay it? Okay. Then we get into leverage. Leverage is the best leverage is to put the least amount of energy into something to get the maximum return, like a mechanical advantage, like a pulley system. What is the least amount of energy you could put forward to get the maximum return? So if I'm prepaying the principal, I'm isolating the principal amount as to how much and when, and then leveraging it, finding out what is the least amount to put down to get the maximum return, meaning I can save more interest per dollar. Okay. To give you an example of that, let's just say you can save $6 in interest per dollar when you're maximized. For every dollar you put on principal, you can save $6 in interest. Now that's maximized. But if you don't know how to maximize, you would be satisfied with $3 in interest savings for every dollar because you wouldn't know the difference on how to maximize how much interest I could save per dollar. All right. So, but if you could save $6, why should you ever accept $3 for every dollar? So our system makes sure that you're saving the most anytime you make a move. And liquidity, that's the last L. Liquidity is understanding all of your money works, whether it is in your pocket, whether it's in the bank account, whether it's on a credit line. We're going to make sure that you understand the fungibility of money. Fungible, fungible. No, meaning that all of your money spends, but not all of your money has the same cost. We're going to show you how to make your money cost less. And I'm telling you, everybody right here, you can clip this, you can play it back, you can ask me questions about it all day. If you have debt, the most expensive money you have is the money sitting in your savings account.
So, thank you, Ice. So, does this only apply to the mortgage, or can you do it with like a car note or something else?
Any debt that carries interest.
Okay.
Any
So it's
debt
pretty
that,
much like like how you in finance, like you do a value of money, like you do a discounting.
no, what you need to know is when you're borrowing money, you want to know how much it cost to borrow money. Just like you would know if you were buying a television set, you would want to know how much it cost, correct?
Yes.
But most people do not know how much it costs to borrow money. So if you knew how much it would cost you to borrow the money, what if you could get it at 75% less without needing more money? Would that be an advantage to you?
Absolutely.
That's what we're talking about today. How to borrow money at a discount. How not to give all of that money to the bank. Now, here is what was happening in 1934, folks. In 1934, just coming out of the Depression, the bankers knew that eventually, if more people were able to purchase homes, they can keep them in debt for 30 years and make a ton of interest based on an amortization schedule where people would be thinking that 3% interest is not going to cost them very much. Anytime you have a 3% loan, folks, you're going to pay back 51% of what you borrow to the bank. In other words, if you had a $200,000 mortgage at 3%, you're going to pay back $103,000 in interest to the bank. That's not 3%, that's 51%. If you have a 4% mortgage, you're going to pay back 71% of what you borrowed to the bank. If you have a 5% mortgage, you're going to pay back 93% of what you borrowed. That is a lot of money. Most of what, listen, let me break this down even a little farther. Let's just use $100,000. Borrowing $100,000 for 30 years at 5%, the bank wants $93,000 interest on a $100,000 loan. How's that 5%? Amortization does that. If you have a 6% mortgage right now, and that's where we are at 6% on a $100,000 loan, you're going to pay back $115,838 interest over 30 years. You're going to pay back more in interest than you borrowed in principal at 6%. So what we're talking about, sir, is how in the world we can do all of this and pay, if you're supposed to pay $115,000 interest on this loan, we can show you how to do all of this and pay about $25,000 in interest instead and not upset your financial apple cart. You can still go on vacation. You can still live well. We're going to show you the math involved and how not to pay all of that interest to the bank. Because if they can turn a 3% loan into a 51% loan, if they can turn a 6% loan into 115.838%, we can show you how to borrow money at an effective interest rate of around 1% or less, just using math, not magic.
Thank you. Because I love math. I love the numbers. So how do I get more information on this?
All right. You can go to PILLmethod.com. So let's go ahead and put that in the chat. You can go to, let's make it easy. Go to ice10k.com. Ice, the number 10, the letter K.com. And then you'll see a button that says get a savings and earnings report. Fill that information out. Follow all of the instructions, especially the one above where you put in your cell phone number. Okay, because people want to go so fast. When you put in your cell phone number and confirm it, wait for the code we're sending you as a text message. Take the code that you receive and put it into the website, and it will allow you to go to the next page when you click on, yes, I want to save. Okay? So and that way it'll let you into our financial form, fill out the financial form, and then you will know the month, day, and year you'll be debt free. Everyone must fill out the financial form to become a P.I.L.L Method client. Somebody online asked this question about what we're doing here. They want to know, how much does your service cost? Okay, so our service cost depends upon what we're doing for you. Anybody who fills out a savings and earnings report they will get the cost along with it. We have people who have what, $80,000 in student loans. We have financial investors that have $2 to $5 million in commercial property. Well, these two people are not going to pay the same thing. So to find out how much it's going to cost, go ahead, fill out the information, and you can know the month, day, and year you're going to be debt free. And you can know how much interest you're going to save. And you can find out what it's going to cost you to get started. Now, here's what you're going to also learn. If you could save more in interest that you don't have to pay the bank, then the program doesn't cost you anything. The program costs you nothing. We actually asked this question in the beginning. If I buy $10 worth of apples and I sell them for $20, did the apples cost me anything? And everybody said no. If we can save you $100,000 to $150,000 in interest, and we get a small fraction of that $150,000 as payment for the program, did the program actually cost you anything? The answer again is no. All right, folks, we have some new moderators on the stage. Flame, are you here?
Yeah, I'm here, baby.
All right, we got Onaje here too. Onaje, how are you doing this morning?
Hey, what's going on?
Listen, we're going to have you guys introduce yourself. But Flame, listen, man, I need you to introduce yourself, because what we're talking about today is understanding credit from a different perspective. You guys and ladies are talking about how people can acquire property, how they can level up their investment game, how they can access credit. We're talking about something that's a little bit different on how to manage and optimize the credit's use. And no one is talking about that. We're bringing that to the stage. So Flame, talk to us this morning about what you do. And listen, man, and I need you to notice we have 13 shares in the room.
Oh man, listen, I gotta let you guys know something. All right, every blue moon, I look upside right now. There's a blue moon outside. Every blue moon, I get a little braggadocious. I do. So currently, right now, I missed my actual flight this morning, the 6 o'clock flight. I did, right? But guess what? But I'm currently sitting right now in American Airlines Lounge, right, where they got free food, free Wi-Fi, free drinks, where you can just have the time of your life. I don't think you heard what I just said. Let me rephrase that. Off of my credit got me into places that I normally couldn't get in. Is that a better way of explaining it? Listen, you guys right now, I want you to understand right now, if you guys are ready to get more information about this credit system and about how it works, right now, I got 14 shares to the room, but it's 62 people in the room. So what I'm asking you guys to do right now, let's get this thing up to 40 shares. You got to get up to 40 shares. So I need 26 shares in this room. And I'm going to show you how we're going to do it. We're going to do it because we ain't going to say a damn thing until we get to 26 shares. You know what I'm saying? So this is what you're going to do. You're going to go to the bottom. You're going to hit the share button. It's going to start with me. So I'm going to hit the share button myself. It says share on Clubhouse, right? I'm going to go up there, right? Man, listen, you guys got to understand about how this stuff works, right? Is being able to share the algorithm of the room, right? I'm sharing it. I know everyone on stage is sharing it. Now, what about you guys that's in the audience? Listen, right now we got 18 shares. Let me be clear, because I don't think you heard me correctly. Right. RB, if I said something that was incorrect, please tap me on my shoulder. Listen, we got 18 shares in the room. I need to make sure that we got 40 shares. I didn't hesitate. I didn't say nothing out of the way. I said 40. Right now we got 22 shares to the room. Man, listen, where you guys at? Everybody wants to have the storyline. Watch this, credit goddess. Everybody wants to have the storyline of nobody taught me this. What happens when somebody teaches you this? Would you actually share what somebody taught you? Or are you that person that says, I know it and you don't? Come on, man. Get out of that frame of mind. Listen, I know right now we got 25 shares to the room. I know we need 15 shares. That's what I do know. And listen, I'm not the smartest man in the room. I'm never going to be in a room where I'm the smartest. But what I do understand is that you guys are smart as well. And as you guys are smart, you guys understand that 50, that 25 from 40 leaves 15. So let's get 15 shares to this room. Let's share the room. Listen, I need you guys excited at a high octane level. No, like really. You get excited by you sharing information that you didn't know and that you let other people know, right? Listen, hold on. I'm gonna make sure this is clear, man. I don't think you hear what I'm saying. I need shares to the room. So you go down to the bottom where they got the arrow and it's got the thing right there that goes up. So what you do is you put this up into the universe so other people can see it. You're gonna hit that share button. It's gonna say share. So you can share on your Twitter, your Facebook, and your Messenger apps, or you can just share on your Clubhouse app. That choice is up to you. And not, but listen, the choice of where you want to share it to is up to you. And not sharing the room is not an option. It's a must that you share the room. Let me find out who's sharing the room. Because if I find out somebody's not sharing the room, we're gonna have a conversation. It's almost like it's almost like we got to bring them back into the principal office and say, okay, well, if you're not getting value of the room, explain to us why, right? And let us help you get to that direction, right? It's 29 shares to the room. I need 11 shares. I didn't ask for it. I'm telling you guys, that's what we need, right? But in order for us to get there, we have to do this together, like one step at a time. Everybody must participate. No, listen, bro, I get it. Everybody knows your name and your song. But what we do need is we need for everybody to share this room. So if you guys are 33 shares, I need 7 more shares to this room. When I say, hold on, because Credit got us an RB, I want to make sure I'm saying something right. 7 shares to a room can save them 23 years of a mortgage. Let me say it again. Can I get 4 shares to the room? Can I get 4 shares to the room? Listen. Oh, it's turn up for sure. It's turn up for sure. Hey, I appreciate you, big dog, for sharing the room. I knew you was gonna share it. I was waiting for you, but you didn't share it, big dog. I saw you. And Miss Lady, you gonna share the room, or you just gonna keep talking about how everybody else ain't sharing? No, listen. No, we do this together. We work. We work. We got 37 shares to the room. I need 3 more shares. Now I'm not. No, we're not gonna play the game about who gonna share and who didn't. I know who did and who didn't. Listen, I gotta get 1 more share. I got 39 shares. I need everybody to share this room. It ain't. Listen, this is a group effort. Everybody must do their part. You don't have to look around and see if somebody else shared it. The question is, did you share it? And how you share it is go to the bottom where the arrow is, look up, and hit share the room. It's just that simple, right? And you get value, you share it back to the people. Right? We got 39 shares. I need to share.
All right, Flame. Tell us who you are, man. So we go ahead. We're going to jump back in here, and I'm going to go over again for those who are just coming into the room how you can get a 0% interest mortgage. I'm going to go over it one more time. Flame, tell us who you are this morning, sir.
Hey, my name is Flame Newton. I'm the author of the School of Credit. Also, I'm the founder of Access to Money. As you can tell, I love credit. I'm obsessed with credit. I love everything about credit. Listen, if you guys want to be involved with credit, listen, that's what I'm about. That's what we teach. Other people money. If you like other people money, if you like using other people money, let me see the number 9 in the chat. That's all. That's all. That's all it's about me.
All right, folks. Flame got a phone call. So, folks, here's what we're going to do. We're going to jump back in here right now. I just put another link at the top. We're going to put the other link in for the article that I wrote that is that we're talking about. The article, I'm going to put that link in the chat. All right. So it's a tiny URL. So let me go ahead and get that link for you all. And we're going to put that in, let's see, we got the private chat. We're going to copy that, copy link address, and we're going to put that in the chat. All right. There you go. All right. We're going to paste that. All right. So here's what you can, if you want this article and this form it is called a comparative. If you want the article with the comparative, go ahead and all right, and we got it on the online as well. Go ahead and copy that, and then you can save that. All right, that takes you to our blog on our website, and you'll have access to the entire article. But watch this. I'm starting at the beginning. All right, so it's a $500,000 mortgage at 6%. I'm sorry, at 3%. At 3%. And in the first 60 months, you're going to pay this loan down by $49,000. That's what we have here. Okay. So let's go ahead and make it bigger on the screen. All right. All right. Let's get that out of there. And we're going to make that bigger on the screen. There we are. Boom. All right. So, all right, let's go to full screen by. All right. So we have $49,000 in principal pay down in the first 5 years, but it's going to cost $63,000 in interest. Your 3% loan really is not 3%. Really, what it really means is 51.778%. If you add the principal and interest together for the first 5 years, that means you're going to be paying out $113,833.20 in the first 5 years, just to get a benefit of $49,000. Does anybody want to pay out $113,833 of their hard-earned money just to pay their loan down by $49,000, less than $50,000? No one does. No one does. In fact, no one wants to pay the bank $63,000 on a supposedly 3% mortgage just to pay the loan down by $49,000. Now, the next line, how much interest does the bank want you to pay on this total loan? $245,866. $245,000. Let's scroll down and let's see, which would you prefer? The left side, which is the bank side, or the right side, which is the consumer side? Do you want to pay $500,000? $500,000, pay that money back, and then pay the bank an additional $245,866 over 30 years? Or would you rather pay about $66,756 to borrow the same amount of money and pay it off in 8.3 years using your current budget, not needing to go out and get an extra job or something? You know, you can still live well while you're doing this. So the only sacrificing that's going on here is on the bank side. They're going to be sacrificing all the interest they're not going to receive. All right. And so now what do you do? What do you do with the money? Now we're talking about a 0% interest mortgage. Watch this now. Watch this. Instead of giving the bank $179,000 to acquire the same asset. Okay. So you're going to save that money. And what if you're paying off in 8.3 years? But most everybody you know is going to be won't be even paid off in 30. But over the next 22 years, you could take the interest that you saved and the money you're no longer paying towards the debt. And the article kind of lays this out. So you want to read the entire article. But what if you could take that money and put it into an investment that is only making 1% return on your money, just 1%? You could turn that over the next 22 years into $1,665,545. The average family is going to pay The average family pays between $300,000 and $500,000 in interest over their lifetime. The average family, nuclear family, pays $300,000 to $500,000 over their lifetime. Instead of paying $500,000, how about receiving $1,665,000 in interest return, interest earned, instead of $500,000 in interest paid? So I'll ask this: even if you paid $500,000, but you received back $1,665,000, if you receive that back in interest made, oh my goodness, did you actually have you actually paid interest, or have you made interest? What we want to show you, folks, is the virtual 0% mortgage means that on all of your debt, you're going to be able to make more money in interest, even if it's at 1% return on your money, than the interest you will ever pay in your lifetime. You're going to earn more than you will ever pay. What do you all say to that? Do we have any other comments about how this works? And now I'm going to get into why all of this is important. Listen, I need some people to come to the stage, and as we got 60 people in here right now, we got 43 shares. All right, and I'm checking out. So LaDonna wants to know how she can see the screen. Go to ice10kvideos.com. ice10kvideos.com. That's interest cancellation expert, ICE, the number 10, the letter K.com, and on a separate device like a tablet or another computer. And then you'll be able to see the screen. That'll take you straight to our YouTube channel. And folks, all of you that are going to the YouTube channel, please, please, please click subscribe. Okay.
Hey, Don.
Yes.
I just wanted to ask people that are in our listening lounge, just make sure that you do us a favor and give some social currency by following Don, Flame, Credit Goddess, myself, not only on Clubhouse, but also on Instagram. And also make sure you tag a friend in here. So ping all of your friends, because Don is giving out some valuable information, and we want to make sure that everyone in our community is able to get access to this information. So please make sure to add a friend, share the room, so that way we can get this information out there and we can kind of build and grow together. Thanks, Don.
And thank you, RB, because see, what you're doing in the housing community, informing people about how they can get a house. What Credit Card is doing is helping them to level up.
If you're talking, Don, you're on mute.
I was going to say back to you, Don.
Oh my goodness. I'm just talking away. Lord have mercy. I'm just talking away. Nobody's hearing me. I was thanking RB for what she was talking about, because in the real estate space, giving people information that would normally count themselves out of buying a house, you are leveling up, teaching first-time home buyers how to get into the game. Credit Goddess, what you're doing is helping people to understand how they can make sure that their credit is in shape so that they can get the house. Flame talks about, oh my goodness, all the secrets involved in personal credit and business credit on how to level up. He's talking about, listen, man, he is in the airport and he's not in the long lines in the airport. Okay. He's not in the long lines. He's not paying $25 for a sandwich. Okay. He's not looking for a place to charge his phone. Okay. He is in an airport lounge using this business credit gives him access to, just because he has the business credit card. He's in the airport lounge getting free food, free drinks, free Wi-Fi while he's waiting for his plane in a comfortable seat. All right. A single chair, a cushion chair, or a couch. All right. And not only that, but probably doing some networking while he's there. This is what we're talking about, folks. So here's what we want you to understand about all of this. All right. And Flame, you got a phone call, and I wanted you to finish up what you were saying about yourself before I get back into this thing. Flame, are you there?
Yeah, I'm right here. I'm gonna tell you what I'm gonna say about myself. I'm for the people. So if you guys, I'm gonna tell you this up front. In order to level up, you got to get in rooms like and like Mr. Don. How are you able to do that? Going up to the house at the top, hit the greenhouse, following the people like RB, who has a room like Lunch and Learn, or Credit Goddess, who's all over the Clubhouse app, and who's in reputable rooms, making sure that you're following people. And that's what I want to make sure that I portray. Listen, you guys, I know that you guys are phenomenal. But in order to get to next levels, you got to hang out with people that are going in the next level, that are at the next level, or that are surpassed that level. And you got to make sure that you tap in with it. So I want to make sure that is said. Other than that, pass it back to you.
Thank you, sir. So, folks, here's what we're talking about. We are talking about right now how banking has been set up since 1934. All right. Coming out of the Depression, bankers put together, the government went to banking and said, listen, we need you to start lending again. So to pull us out of the Depression, the bank said, what's in it for us? Amortization schedules and a government-backed lending situation whereby people can get their loans, 30-year loans, amortized by people in business who own banks, and they'll be able to get 30 years worth of interest amortized, meaning that a 3% loan will actually give them a 51% return, and a 6% loan will actually get them a 115.838% return. The average family pays between $300,000 and $500,000 in interest over a lifetime. Listen to this. If you're in banking, and let me tell you something, when you do the research, you will find out that the biggest contributor to building the middle class between 1934 and 1962 is home buyership. Not ownership, buyership. The ability to buy a home on time for 30 years or more. And the bank says, oh, you mean the average family is going to pay between $300,000 and $500,000 in interest? Oh my goodness. We're going to break this down for you right here, folks. The bank saw the ability to tap a natural resource. What is that natural resource? Your time and effort. Your time, your effort, paying 75% more interest than you need to on these loans. And this is why the Bible says the borrower is slave to the lender. The borrower is slave to the lender. And if I can get you as a banker, if I can get you to give me money over your entire working life, pay interest on a loan. Now, it gets a little deeper than that. Here's what I need you to know. Bankers don't lend out their own money. They borrow our money. Okay. And for every dollar on deposit, okay, this is called fractional reserve lending. Look it up. For every dollar on deposit, they can lend out, depending on what's going on, between $7 and $10 they don't even have. One more time, folks. For every dollar you have in the bank, they can lend out between $7 and $10 that they don't even have. You sign a note that says you're going to pay back interest on those fictional dollars until it's paid off. So they're writing numbers into your account, because when you bought your house, did anybody actually get the cash? When you bought your house, did you actually touch the cash and then give it over to the person that built the house? Did you actually touch the cash? Did anybody ever see the cash? RB, I mean, when you're at a closing, is there a big pile of cash at the table? Or are they just writing it into your account? Here, folks, I am not anti-bank. I am pro-education. RB is educating. Credit Goddess is educating. Flame is educating. The P.I.L.L method educates on how you can borrow money at a discount. Because of all the money that they're making through amortization, there's a weakness in this schedule. There's a weakness in it. Does anybody want to know what that weakness is? If you want to know what the weakness is in their system, so that I can, what we just showed you here, that you can cut your interest cost by about 75%, only pay $66,000 in interest, where the bank wanted $245,000. If anybody wants to know where the weakness is, go ahead and put it in the chat that you want to know. Yes, I want to know. Yes, I want to know. Put it in the chat. All right. I want to know. All right. And so we're going to get into this we're going to put this $500,000 loan at 3% in our program here. So we're going to open this up. We're going to put we're going to put $500,000 in here. Okay. At 3%. And you're going to see the same numbers I had before. Here it is. Here's your payment, folks. On $500,000. On $500,000. Oh, and I got 43 shares in here, and we got 59 people in here. I think we could, listen, I'd like to get 100 people in the room. So if I can get a few more shares, I think we can get more people in the room to be able to see this. Remember, the overall arching thing is we want to make more money in interest than we ever pay. Okay. You want to make money in interest than you pay. The reason why this is such an opportunity cost lost is not the extra 75% in interest that you're paying. That's not the big problem. The big problem is that the 75% extra interest you're paying cannot make money for you because you're spending it on interest. This is the money that is supposed to be put back for laying up an inheritance for our children's children. But right now, folks, we're spending our children's inheritance on interest. The average family pays between 35 and 39% of their take-home pay on interest payments. 35 to 39%. And these are people that make good money. So if we can cut that down so that we don't have to pay all of that interest to acquire the same asset, could we then invest that money we were willing to give to the bank? We were willing to pay it, but now we don't have to. What if we're conscientious about that savings and invest that money instead of spending it on interest? Let me show you something here. We have on the screen, if you're new to the room and you want to see this on the screen, go to ice10kvideos.com. And also, we're going to do a quick reset. We want you to follow RB. We want you to follow Credit Goddess, Flame, and myself. Go to, we're in the Mortgage Syndicate, and we want to click on that green mansion above. And we want to thank them for allowing us to be in their club this morning by giving their club a follow. Also, by hitting my profile, you can scroll down to find the P.I.L.L Method Club and join it as well. This kind of information, the reason why we're focused here, folks, is because we have for too long thought that banking was on our side. Banking is on their own side. It is a business. And what I want you to know is that I absolutely love the bank. Why do I absolutely love the bank? Because they have a product that I need. Okay. I love the bank just like I love any other product that I have a coupon for 75% off. I love it even more if I can get 75% off. If right now, if you could get gasoline at 50 cents a gallon, if I knew if there was a way for you to get a discount so that you could get gasoline at 50 cents a gallon, who wouldn't want to know that? I will be able to show you. I'm telling you how you're going to be able to get about 75% off on the money you borrowed. And what we're doing is not paying attention to the interest rate, but the interest cost. Let me show you something here at 3%. I'm also going to show you what Credit God was talking about earlier, that is actually easier. Once you understand an amortization schedule and find out the weakness in it, it is easier to pay off the loan at a higher interest rate than it is a lower one. We started here at 3%, folks. The payment is $2,108.02. If you have any questions, come up to the stage, because I'm by myself today. Therefore, I won't be able to spend a lot of time in the chat. All right. So out of the payment of our regular payment here is $2,108.02. I want you to see here what's going on. Do you see that $858.02 goes to principal, actually paying down the loan? How much interest, how much money is going to interest? If you can see this, write it in the chat so people can see how much interest folks are paying on this very first payment. I need to know how many people are actually watching this and listening in and paying attention here. How much interest are they paying? Does anybody on Clubhouse actually seeing this so that they can write in how much interest is being paid on the very first payment? Can we get that in the chat, somebody? All right. 1,000. There it is, Jonathan Jones, $1,250. $1,250. And Brenda Jackson put it in. $1,250. Folks, how fair is that? That a person with great credit, I mean excellent credit, borrows money, makes a payment of $2,108.02 towards their mortgage, and only $858 of that money pays down the mortgage, but $1,250 goes to interest. How fair is that? You need to know that because this is set up to make more money than it should. This is why it's not taught in schools how an amortization schedule actually works. It's not taught in schools. I need you to think about that. Let that breathe for just a second. It's not taught in schools. It's not taught to, when you get your real estate license, what we're learning here about amortization schedules, you don't need to know to get your real estate license. What we're teaching here about amortization schedules, you don't need to know this to get a license to do mortgages. It's not taught. Bank owners understand it well, but people who work in the bank don't understand it at all because it's not required for them to do their jobs. If the information got out, you could save at the same rate you're being charged. And that's where the savings comes from if you understand this, if you understand how this schedule works. Look at payment number one. Let's just say it is in January. Let's just say it's in January. You make your first payment in January, and $858.02 is subtracted from what you owe, and you're left with $499,141.98 of the principal payment on line one. Okay, it's there. All right. And now you could see the payment for February because we have the schedule right there in front of us. $860.17 will go to principal. So a little bit more money goes to principal, a little less goes to interest, all the way down on this schedule. Okay. A little more money to principal, a little more to interest, but they all add up to the very same payment. And we soon lose track of how much interest we're actually paying out of that payment. We get used to paying it just like we were paying rent on an apartment or a house. In fact, the interest column is nothing more than rent on your money. The interest column is nothing more than rent on your money. So we go from renting an apartment to renting money our entire working lives. So this is what banking is looking at. They're looking at a valuable resource, how they can take your labor, your time, and turn it into a windfall for them. They're taking that and turning it into interest money that they're going to be able to receive because you signed a promissory note to give them that money on fictional dollars that they're lending you, because for every dollar they have on deposit, they can lend out $7 to $10 they don't even have. And they're going to make money on it for 30 years. Do I blame them for doing that? No, I don't. Business is business, folks. We need to be educated on the process so that we don't have to pay all of that interest. Here's where we're going. Here's where we're going with this. So if you want to ask a question about this, come on up to the stage. Do I see somebody's hand raised here? Somebody raise their hand to come up? All right. Oh, I don't see it. Hold on. Let me check. Nope, I guess not. All right. Let me see here. Oh, maybe there is somebody. Let me see. I'm looking for you. I think I see. There it is. All right. Invite to speak. All right. So Dr. Wynn, we just invited you to come up. How are you doing?
I am wonderful. Good morning. My question is this an amortization schedule, and are they required to give it to you, or do you need to ask for it?
All right. You can ask for it. Most people get it when they close on their loans, or you can create one yourself. Actually, I just created this one online using Brett Whistle, B-R-E-T. That's his name. B-R-E-T, Brett Whistle, W-H-I-S-S-E-L. You can use this same one I'm using, Dr. Wynn, and create your own. All right, we have somebody else who just raised their hand. And I think what you need to understand, Dr. Wynn, is what I'm getting ready to teach. Anytime you make a change to your amortization schedule, it destroys it. You need a new one each and every time. This is why we have our computer the computer does all the work for us. All right. So we invite somebody else to speak as well. So Dr. Wynn, do you have any other questions for me today?
You said Brett.
Mm-hmm.
W-I, spell that last name one more time, please.
W-H-I, S as in Sam, S as in Sam, L-E, Brett Whistle.
Gotcha. Thank you
And
so much.
And you can Google it. And the reason why I use this is because we need to be aware of how much money we're spending. And this is the only one I found that will actually add up for you how much interest you're spending at any given month. The one you get from the bank doesn't give you this. They give you three columns: the principal, the interest, and the principal balance. The bank will never give you an amortization schedule that adds up the interest and the principal that you paid on any given month. And I'm going to show you why. If you can see what we're talking about here on line 12 of this amortization schedule, and you make your payment on time every month, you would pay that loan down by $10,439. But do you know how much interest you're going to pay in the first year? I mean, it's easily added up. I can see it here. $14,875.24. Dr. Wynn, on a 3% loan, on a house that you guys absolutely love, would it be concerning to you that in the first year you paid your loan down by $10,000, but it cost you $14,875 to do it?
Extremely concerning. I'm looking at it now.
Okay. But the reason why it is not concerning is because we're not paying attention to how much interest we're paying. It's called inattentional blindness. We're blind to what we don't pay attention to. We're blind to what we don't pay attention to. So we're at the P.I.L.L method. Our goal is to make sure that everybody understands what's really going on here and how to save this money in interest by pointing out the weakness in an amortization schedule. Dr. Nguyen, did you have another question?
No, thank you very much.
Please stick around in case something comes to you. We want to hear from you. Okay. All right. All right. Mountain, what's up?
Good morning, all. I'd like to ask your perspective on what you think the mortgage interest rates are looking at over the next 90 days.
I love the interest rates over the next 90 days. Absolutely love them. If you can afford the payment, the higher interest rates are better than the lower ones. What did you want to ask me specifically about the interest rates, Mountain?
Because I'm looking at an upcoming mortgage for $5 million, and I'm wondering, should I go ahead and lock it in now at 5.5, or should I wait and see if the interest rate might come back down in the next 90 days?
All right.
Or should I just go ahead and just say, take a whack at it?
Sir, can I be perfectly honest with you? Once somebody understands this, I've had people ask for a higher interest rate than the one they were being offered, especially if they're in business. That's how much we don't know about it. Can you imagine being in a position where you could take a look at your finances and say, you know what, based on what we have here, we'd be better off at a higher interest rate than the lower interest rate the bank is offering. Does that seem a little crazy to you?
Yeah. So why would you want the high interest rate, and your payments are going to be higher?
All right, let's go. Because the reason why you do that is for everything else. Are you building a building? Is this something you're building or something you're just buying?
Yes.
Okay.
Yes, it's a building I'm building.
All right, so building you're building. So do you care how much the concrete costs?
Well, overall, I want to see my profit margin.
Yeah. And when you're breaking down the profit margin, do you take a look at labor costs?
Of course I do. I take a look at the labor costs, and I take a look at, the supplies.
Right. But what we don't look at, and all of the things that you're going to break down to put this thing together, to put this deal together, do you know the one thing that people don't realize is the interest costs on the loans and how to mitigate it? You know how to make sure I want to get the best materials I can and pay the least amount for it, correct?
Correct.
And it sounds like you've been in business a while, but what if there was a way for you to borrow money and pay the least amount of interest that's mathematically possible that you never even heard of before? Would you like to know more about that?
I sure would.
All right. So can you see my screen right now? Are you watching my screen? You can actually see if you're near a computer, you can actually see what I'm doing on YouTube. Are you near a computer, sir? If you're speaking, we can't hear you.
Okay, I'm about to power up my laptop.
All right, folks. So somebody put that in the chat. So when he gets that his computer powered up, he can see ice10kvideos.com. And if you get that link, it'll take you to our YouTube channel, sir. Just click on the one that says live, and you'll be able to see what we're talking about. So I'm going to continue on here. You can just listen in and come back in at any time with a question. Okay.
Sure will.
All right, folks, here's what we've got. So I'm showing you that in this $500,000 mortgage at 3%, we have $858.02 going to principal the first month, which is January. And let's say we make our January payment where $1,250 goes to interest on the first line. we're paid down to $499,141.98. There you go. The bank uses the principal balance on line 1 or on any line to determine how much interest is paid on the very next line. So you don't need to know very much about this. You just need to know whatever line we're on, we're going to pay the interest on the very next line based on the principal balance on the current line. All right. So based on this, we're supposed to pay on line 2 $1,247.85 in interest. But let me show you something. If we make our payment in January, the February principal payment is $860.17. Do we have to wait till February to give the bank that $860.17? I need you to put that in the chat, folks. Do we need to wait till February to give the bank that $860.17? Yes or no? No. Okay, I see it. No, you don't. People are putting it in the chat. No, you don't need to pay that. You don't need to wait. If you had it, you can actually pay that money in January as well. If you did, no interest comes out of that money. It's written into your contract that that money would go to principal. Now, I know that if you are a real estate investor, that on some of these loans, there is a prepayment penalty built in, and I'm going to handle that. Okay. But keep this in mind, prepayment penalty, but I need you to change one of those words into prepayment cost. Instead of prepayment penalty, change it to prepayment cost, and we'll handle that in just a second. All right. So now we're going to give the bank this $860.17 early. We're going to give it to them in January. And all of that money will go to principal. So we're paid down to line 2 in January because we gave the bank $860.17. We chose the timing. We didn't let the bank create the timing for us. We chose the timing in which to give them money that we had. So we gave them the $860.17. All of it went to principal because they already received their interest payment for January. So now we're on line 2 where we owe $498,281.81. And so our next mortgage payment then for February, remember, whatever line you on, look to the next line. Our next mortgage payment for February is on line 3 of the schedule, where we're paying $862.32 and $1245.70. What just happened? We just eliminated line 2 of our amortization schedule for only $860.17 instead of the $2,108 the bank wanted. What? We gave them $860 and we turned our 360-month payment into 359 monthly payments just by giving the bank $860.70 early? Yeah. What about this? The $1,247.85 the bank was looking for on line 2 has been canceled. You don't owe it. You don't pay it. The overall interest cost on this loan has been reduced by $1,247.85 because of the weakness in the amortization schedule. So, Dr. Wynn, what do you think of that?
I think that is outstanding. And as I am sitting here preparing for August the 1st of paying, is it possible to, not possible. Does it still work if I don't pay it all right with my first payment? Can I then come back in a week or two and pay the $860.17 principal? Does that still apply? Does it still work that way?
Dr. Wynn, flesh and blood did not reveal that unto you.
I'm asking for a friend.
Listen, as long as the bank receives it before the 1st of the next month, you save that money. You save that interest. How's that sound?
Perfect.
So listen, what we're doing, Dr. Wynn, is we're just giving you the basics so that you can understand that it works. What we're also providing with the P.I.L.L method system, we're providing the exact amount of money you need to pay to the penny to save the most in interest per dollar. So, do you want your dollar to do the most for you it possibly can?
Absolutely.
Okay. So, knowing that if you pay if you pay the wrong amount at the wrong time, do you realize you can actually pay too much at the wrong time and it can actually hurt you?
Good point.
All right, let me show you something here. You're obviously watching my screen, right?
Yes.
Now, we're looking at cumulative principal here. I'm looking at column 3 and column 4. I got a few minutes left here. So I need to finish up here. Column 3 and column 4. And if you look at line 12, you'll see that if I'm going to pay down $10,000 that the bank wants me to pay in the first year and pay them $14,857.24, if I pay them using their payment schedule, here's my question to you, Dr. Wynn. Do I have to pay the $10,439 in 12 monthly payments? Do I have to?
No, you do not.
If I had it, could I give it to them all on line 1?
Yes, you could.
If I did, would I be paid down to line 12 in 1 month?
Yes, you would.
And what happens to all the interest payments between line 2 and line 12? What happens to all those interest payments?
Canceled.
And my next mortgage payment for February would be on what line of this schedule?
Line 12
You're
or
already-
13.
13. There you go. Come on.
Early in the morning.
That's what we're talking about, Dr. Wood. So I can save. That means to do the exact same thing. If I had the money, I could save $13,631 in interest. How does that sound?
Perfect.
So here's what we're talking about. I'm going to put a little calculator on the screen and I'm going to ask you a couple of questions and then I'm going to finish up. Let's just say you could put any amount, a penny extra, a dime extra, $500 extra, $231.67 extra. You can put anything you want down. But what you want to know is when I put it down, how much interest am I saving per dollar? You know, that can be figured out if somebody's doing the math, right?
Right.
So what if I just gave you 2 choices? Out of all the choices, I just gave you 2 if you have plenty of money in the bank. We're looking at line 12 and line 24. I could give the bank $10,439 early and knock out 12 payments. Or I can look at line 24 and give them $21,000 and knock out 24 payments and save about 29 grand in interest. So if you had plenty of money, which one would you choose?
21,195.51.
And why is that?
That's down because that knocks out 24 months of interest.
And so
24 payments of interest.
Exactly. Now, here's what the bank is looking at. How much interest can I make on this deal? And how many mistakes can I get my clients to make? Because the more mistakes they make, the more money I make, right? So
Right.
if I'm looking at 14,000, so if we look at line 12, all right, the 14,857 in interest, right?
Right.
And 24 cents. If I prepay the $10,000, I'm not going to pay all that interest, right?
Right.
So if I take the interest I could save and divide it by the amount of money I could pay, the $10,439, will that tell me how much interest I'm saving per dollar?
Oh, I see. Okay.
I see. So says a blind man. Okay, so what we're going to do is divide this. All right. So we're going to divide it by 10,439. See, there's more to this than meets the eye. And the bank owners know this. Okay. So, and then we do that. So I'm saving $1.42. So for every dollar you apply to principal, you're saving $1.42 in interest. How valuable would that be to you?
Extremely, saving more than what you're paying.
So listen, even if it was $5, it just makes even $5 look better now, doesn't it?
Absolutely.
So if I'm saving, so if you gave me $1 and I gave you back $1.42, how many times would you do that, Dr. Wynn?
I'm giving you dollars all day, every day.
Okay. The bank has to do the exact same thing. Do you realize how important it is for the banks for us not to know that?
Yes.
That's why it's not taught in school. Okay, now watch this. Now I'm saving $1.42 in interest for every dollar. So now I'm going to clear this out. I'm going to put in, I'm now on line 24, where we're going to put in $29,396.97 and divide that. Okay, hit divide. We're going to divide it by the 21,195. Okay, 21,195.51 and equals $1.38. If I could save $1.42 per dollar, should I ever accept $1.38 per dollar in savings?
No.
The bankers know that. So moving the right amount of money at the right time matters. So why does this matter to us on a larger scale? Because we're making plenty of money. It's just too much of our money is going to interest. What if we could determine, Dr. Wynn, that I'm getting my best return on my money at this much money I have, and once I receive the best return on my money by putting it towards saving interest, then putting any more, I'm losing out, aren't I?
Right.
Then what do I do with that extra money? Should I put it into some sort of investment and make money with it now?
Sounds like a plan.
So what if there was a computer program that helped you to determine how much you were supposed to put towards debt reduction and how much you were supposed to put towards wealth creation out of your money?
Then we should all get that.
So listen, doctor, go to ICE. So go to the top of the page. You just click on ICE 10K live up.com up there, or ICE 10K ice10k.com. Doesn't really matter. They'll all go to take you to my digital business card. You'll find on that card, you'll see getting a savings and earnings report. Make sure you get a savings and earnings report. Follow all of the directions, and we will put together a report for you so that you can know the month, day, and year you could be debt free with your current budget. And you don't have to sacrifice lifestyle. You don't have to cut up your credit cards. You don't have to eat beans and rice 7 days a week. You don't have to, stay home and not go on vacation. Okay. And you don't have to drive a 30-year-old car forever. You can live well. Why are you laughing at me? Because you know somebody who says all that, don't you?
Yes.
And I live in Huntsville, Alabama, and that guy lives about an hour and a half from me right now. Okay. So this is what we're talking about, folks. We're talking about how to save money, how to borrow money at a discount, so you don't have to keep giving all of your money to the bank. This is what we mean. And I'm going to play our new television commercial for you one last time, where we have worked with Dr. Eric Thomas. That's E.T. the hip hop preacher, and he gave us some information here, and that we've actually turned that into a television commercial, and we actually put it on social media as well, and so that we can help get the information out. Dr. Eric Thomas, E.T. the hip hop preacher, he is the most sought after motivational speaker on the planet right now. He is number one. If you go and Google top 10 motivational speakers in 2022, because you got to put in 2022. If you put in top 10 motivational speakers in 2022, he's at the top of the list. And we had him as a speaker at our event in May. Here is what he said, and how this is how we turned it into a commercial. Watch this, folks. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L Method. I invite you to watch and listen.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today. Ladies and gentlemen, you just heard it. No mortgage, no stress. If you would like to be there, and it's not just the mortgage, that's all of your debt. That's everything. And if you saw the commercial, you saw me handing him my book. I actually got to give E.T. an autograph copy of my book. And we're putting that book on the screen. It's been a 5-time bestseller on Amazon. And it's the only book on, it is the only book on Amazon out of 33 million titles that talks about how to save money on interest using your current budget and how to optimize it using an opportunity cost calculator. Our calculator is our artificially intelligent program does all of the math, takes out all of the guesswork. If you want to know how you could be debt free and how all of this works, and you want to start teaching this information to your children, to your grandchildren, to your nieces and nephews, how to get this information into their hands, go ahead and get the book today. All right. Also get your savings and earnings report today. I want you to be able to follow everyone, the moderators that we have on the stage. I want to thank everybody for coming in here. We're going to do some outros, and so people can get to know us just a little bit better. And if there's any other questions, we want to handle those questions. But our online people have to go. We only have 2 hours to spend, but I wanted to make sure that if you, we're going to put that in the chat one more time. We're going to put that, the URL for my article for how to get a virtual 0% interest mortgage. We want to put that in the chat as well. So let's put that in one more time. All right. How all of that works. My. Let's go ahead and let me get that and put it in one more time. And then we're going to say goodbye to everyone. So let's go ahead and put that in the chat online. I want to say goodbye to everybody online. And we'll see you on Wednesday. And I'm going to put up a new subject that you're going to find very, very intriguing for Wednesday. Oh my goodness. So follow me, follow the P.I.L.L Method Club. And when I put up the new subject for Wednesday, you're absolutely going to love it. See you everybody online, but hang out here if you're on Clubhouse. All right. Let's go ahead and